forward will reflect to the framework. So I would think of it that way. It doesn't dictate particular outcomes, though, at particular meetings or the timing of those outcomes, other than the goals that we're seeking to achieve. The review is really part of a broader program, and the economic question we had to answer was how to adapt our framework to what we really had learned since the global financial crisis during that long expansion.
We're listening to Jeremy Powell.
We knew, that we were going to be closer to the effective lower bound in all likelihood, and had to address that as I described in my remarks. We didn't know how it would come out. I'm very happy with where it came out.
So this is the Fed talking about changing their mandate, or changing the way they're going to think about inflation going forward. They're saying they're going to let inflation go way above their 2% target. They're going to try to sugarcoat this, but this is not good for TLT.
In the process of engaging with lawmakers and engaging with the general public on these issues and seeking input and accountability, I think that is a most welcome thing when you do that. And so I think even apart from the gains in the framework, that was something I was quite struck by. The economy in their lives, and it was just riveting.
So the bottom line here, we can listen to more questions on this. I don't think we need to listen to any more of this. Basically, Powell is saying they're not going to stifle the economy if inflation pokes its head up. That they're more confident that inflation, if it does happen, will not be detrimental to the economy. And what he's telling you is he thinks that we can go ahead and let inflation poke its head up. So what's going to happen is long-term rates are going to go higher, TLT is going to go down. And then other institutions who have been suffering from low rates, like banks, are going to take off. Okay? So I bought a call in here yesterday just in case this happened. So banks are going to rally big here, and the TLT is going to drop. And then all your highly speculative, highly leveraged companies are going to benefit from basically the short-term rates that we have today. But eventually this is going to be a problem for them down the road. But what this means is we're going to be allowed to have some real asset inflation, and that's going to be huge for banks, and that's going to be bad for TLT because they assume that rates would stay low for a long time and that the Fed was backstopping the TLT. Now, it's interesting that they're willing to do this, but time will tell just how much unwinding we need to do. But the first alert here is to let you know is you don't want to be long TLT right now, because long-term rates are going to have to adjust to the reality that the Fed is no longer backstopping long-term rates. What they're telling you is they're happy for inflation to overshoot their 2%, and they're not going to hold down the economy. And the reason why they want to do this is that they don't want to have their hands tied when it comes to the next crisis. So they acknowledge the fact that once you take your rates to zero, like in Europe, the only thing left to do is negative rates. And as you can see in Europe, negative rates, it doesn't seem to be working in Europe. So the Fed does not want to go to negative rates. They've observed what's happened in Japan and Europe. They're fearful of having to be forced to go to negative rates. So the way they're dealing with this is they're going to let rates rise here once the market understands that inflation is going to be allowed. Now, whether you agree with inflation or not, that doesn't matter. What's important is the perception of what can happen. Now, there's a lot of money long bonds. So as we're watching this thing drop here, this, where can this thing go? It's hard to say. We don't know how long the market is, right? We don't know. So we're going to find out here pretty quickly, because as the investment strategists and all these big funds kind of digest what they're talking about, it's going to take them some time to have their meetings and decide what they want to do here. But the point of that message from Fed Powell is we're not giving you a free put anymore on rates going up. Okay, so that free put that they offered has been taken away for rates, and so inflation can rise, and then we'll have to see what happens to interest rates. Now, it doesn't mean it has to happen that way. It doesn't mean rates got to jump, but what it means is that free put has been taken away. All right, so as we talk about option strategies, before you could buy TLT because if inflation poked up its head, the Fed would raise short-term rates and the yield curve would be inverted, okay? And then they would stifle that inflation so rates could stay low on the long end. And TLT is an average duration of 18, right? So this is telling you that the long-term rates, which always benefited from an inverted yield curve because of the focus on keeping inflation low, is no longer going to be there. So now we have to value that put. Like, what is that put worth, right? And then the market has to adjust to that. So we don't know the supply and demand component, but if I were to look at this, I would say this market is probably very long high durations or bonds. And so I'm long puts and I'm short TLT. We'll see what happens. I mean, anything can still happen, but the next reaction to this piece of news, I would be surprised if it's up versus down. But anyway, we're watching it in real time right now. We just listened to a little bit of Fed Powell, and this is what's happening with TLT. I would be very careful being long 30-year, 20-year, 10-year bonds if we know the Fed is no longer protecting us from inflation. But there you go. Good luck.